big buff dude's just like, man, I'm gonna get that gold.
Let's go, Sameer.
And then what does he do? What does the skinny
And then
fella
the
do?
scrawny guy thinks a little bit and
Wait, let's recreate this. I'll be the scrawny guy. You can be the jack guy.
sure, okay. So G, the scrawny
G.
guy,
Well played.
G
So
decides
You're
to
digging, and then I go away. I read some books,
read some
Oh,
books,
I know
yeah.
the name of the book.
What?
Skinny Indian, Buff Indian. A book about finance.
Three, 2, 1. All right, everyone. Welcome to episode 28. Boys, so last week we talked about budgeting.
Okay.
And this week, now that everyone's saving their money, what do we recommend them to do?
Yeah,
That's a
man.
good one.
So I think that was a good one because, growing up, what are we taught in school? We just taught to get a good education in a field of like science, medicine, or law, and then trading our time for money when we get our jobs. But then after that, like, what do? We're not really taught in school at an early age what to do with the money that we get from our jobs. And I think that's what this podcast is really going to be about is, if you get a little bit of education in personal finance, then you'll, like what we did, we stumbled upon the gold standard, which is the S&P 500. And, if we, historically speaking, if we compare that, like if you're saving your money in a bank account, historically the bank account was giving you about 1% interest over time. But, over time due to inflation and things like that, we'd be lucky to get 1% now. Last time I checked out, I was getting like 0.3% in my bank account. And that's just like, I look at that and there's like a teardrop that comes down my face. It's so sad. Like the people that don't know what to do with their money. And, we're in a very lucky situation where we stumbled upon something like the gold standard, which is the S&P 500. And compared to the bank, the S&P 500 gives you about 10% returns.
It's like 10 times better.
10 times better. And that's like over 100-year window.
Absolutely.
And, if we learn something like this at an early age, we could really get a head start.
You were talking about in school when we didn't get taught. And I remember even the terminology like living at home about money in general. The only conversation I had, because there wasn't a lot, I should say. There was not a lot of conversations about money, was whatever you make, just save it in the bank. Leave it in there, store as much as you can, and you'll be as well off as you can imagine. So I think it like highlights there how like uneducated like the people from that socioeconomical level are. Right. It's like believing, as we pointed out in the previous podcast, you can't get rich from literally just saving your money.
No.
You have to have a multiplier.
Yeah.
So just putting it in the bank, losing money on inflation, just doesn't make sense. So you need at bare minimum a vehicle like the golden standard,
Yeah.
which we're about to explain today.
Yeah, I feel like there's levels to this, man. Like, so it starts with like, the younger people who just start getting money. They're like splashing the money, going around splashing the money. And then there's a next level where people are starting to think more about their finances and they're saving.
Yeah.
But then they don't know what to do after saving.
Yeah.
So
We were like talking about, I think 2 podcasts ago where, our personal stories with money, we would look at, wealthy people and just wonder how the hell do they get that?
yeah,
And they don't get that by saving. That's the reality. They don't get it by saving. They buy assets and the assets pay for their lifestyle. So how do we buy those assets?
Yeah. So let's explain the S&P 500 a little bit more. So what it is it's like an index fund, where an index fund is just a fancy name for like a big bucket. So think of like a bucket full of investments. So where a lot of people go wrong with investing is they're always trying to find like the next big thing. I can find this little tiny company, like a little mining company or something.
It's
like
usually
that.
a mining company.
Yeah, it's usually
And they usually know someone on the board. They usually know what's going to happen next.
And it never works out still. So like that's like you don't want to go down that track, because with this, one of the reasons why it's called the gold standard is because no one, like even professionals, very few people can outperform this S&P 500. So this bucket, so it's saying S&P 500 is the top 500 companies in the US.
Mm-hmm.
So I think of it like a bucket that has 500 of the best companies, and it keeps those 500 companies in it. And then if one of them starts to underperform and starts to go down, then it'll automatically just get kicked out of the bucket and replaced with something better. And it's a ripper because if you're holding the best 500 companies, it's extremely diversified. And then you're holding the best companies practically in the whole world because you're betting on the strength of the US market.
Absolutely.
You
So
know?
the S&P 500 is market cap based,
Yeah.
which means, you're literally investing in the top 5, like the biggest 500 companies. The companies have proven themselves over many, many years. They're companies that are often not the most profitable. They're companies that, they give us everything that we need. They give us these phones, these computers. They build all the infrastructure in the world, like everything that we can think of.
Yeah.
That's what's in this bucket. And like Dylan was saying, America's the biggest, baddest, and the best country.
Yeah.
Like that's where all the talent goes. That's where all the money is.
Yeah.
That's why America is one of the best countries. That's why we choose to invest, a majority of our investments and net worth there, right?
Yeah. Maybe something that the audience can do is just like quickly pause it and just type in on Google like S&P 500 pie chart, and you'll see like you can visualize like what's actually in the S&P, and then just type in S&P 500 holdings just on Google, and then you can see the exact percentages. Like you'll see like Apple's the biggest, and you got all these other companies like Amazon, Google, Facebook, and just look at like what's actually in it.
Yeah.
Oh, absolutely.
Yeah, I think as well, like the reason why it's also the gold standard is because if you're comparing it to a bank, right? Let's think about a bank savings account as an actual investment. All you do is click a button. Well, you don't even click a button really. Like it just arrives there from your paycheck. So because you're doing no work, you get no gain. You get hardly any gain. You're not doing anything. Where the gold standard, it's one extra click to transfer it from your bank account to your investment platform, and every single investment platform has the gold standard. It's the most popular investment there literally is in the whole entire world. And then just by one extra click, you're getting 10 times the result. 10 times, 10%. And even if you compound your money at 10% for a long period of time, it turns out to be quite significant.
Yeah.
Absolutely.
So like I think the wealthy, if they don't know where to place their money, they're probably going to just default to the gold standard. And for them, it's like cash, because the great things about investing in the stock market is you can sell it instantly and have your money back. Like with most platforms, definitely within the week, some like literally instantly.
Yeah, absolutely.
So it's like cash for them. The rich, they don't have any cash. They have very small amounts of cash, and the rest, a lot of the time, it's in the gold standard, or if they believe they're smart enough, they're going to invest in something else where they can beat the gold standard.
Funny you say that about it's so easy to get your money back. The hardest thing about getting your money back from investing is actually through the banking system. It's pretty much automatic clicking sell and withdraw, and it takes a few days to even hit your checking account.
Yeah.
Which is a goddamn nightmare. I was thinking as you were talking then from only having to click one extra button and getting so much more return. I think people add a certain amount of risk to like an investment portfolio. So like it's riskier than a bank account. And what I usually say to people, or what was first taught to me as well, was when you're putting money in the bank because of inflation, you're 100% losing money.
Yeah, in the long term, it's guaranteed loss.
Yeah, the probability is 100%. You are going to lose money. With an investment account, at the worst, it's a maybe. And when you invest in something so safe like the S&P 500 that's been around for 100 years and on average returns 10%, you start. I think I was explaining this the other night. I was like, sometimes it's just common sense.
Yeah.
Like you look at things and go, they've been around for so damn long.
Yeah. And I think the genius of the S&P 500 is, just to hone in on, it's a mathematical like formula or equation.
Yeah.
It's cycling and keeping the best 500. So if these ones die, the S&P 500 cannot die because new things just come into it.
Absolutely.
Yeah.
So it's always going to be siphoning out and, kicking it and watching your capital for you.
Hey, Doc, I just want to ask you, sir.
Yo.
You said, so when you save your money in the bank, you're 100% going to lose your money. Did you want to explain that a bit more just for our audience?
Absolutely. So
What that means?
as we were talking about before, the bank itself, when we first started hardcore, I think we're going through this, but what was it, 1.5%, 2%?
Yeah, something like that.
You know, that was the interest rates back then. Something close enough to that. Now it's what, 0.25, 0.5 now.
Yeah, it's nothing.
Right. And inflation in America was like 8%.
Yeah.
Here it's, I don't even know, what, 6% or something.
Yeah, probably. Yeah.
Whatever it is, you know. And those are the numbers that we get. It's probably something more like 10%, right? But the stat we've used for a long time is inflation was 3%. So that's the kind of math I'm going to use today. So if the interest rate is 1%, or it's 1.5, or it's 2%, inflation is 3%, essentially you're losing a percent of your money 100% of the time.
Yep.
Just by living in the bank and doing nothing. So you're losing that percent of purchasing power year on year on year.
Yeah.
See, that was mind blowing for me to learn that when I first learned that.
Oh, me too.
Because in my head I was like, oh, bank's safe. That's why everyone's like, saving in there. But then when you learn that fact, you're like, man, why am I saving something in something where I'm losing my money?
Yeah.
It's a guaranteed loss as well. Like just honing in on that point, because I talk to my parents about this all the time, and they come from, they're immigrants, right? So they come from a place of fear with whatever it is that they're doing. So they worked really, really hard to give me and my siblings a really good life, a head start essentially. And obviously they're not educated on investing. All they know is investing in tangible things like a land or a house or gold. That's like a traditional Indian investment.
Oh, yeah.
Those three things, right? So for them, like just honing in on like something that's safe, for them it was normal. They thought it was a really good investment to either, if you're not investing in a house, land or gold, just put it in the bank.
Yeah.
And they didn't even know about stocks. And it's really affected my parents quite a bit, because with the knowledge that I have now, I feel really, really lucky to be able to share that with them.
Absolutely.
Because I showed my dad back in '99. This is a true story. My dad bought a house with a down payment of just $5,000.
That's crazy.
Which is crazy, right? So the house that we bought that they're currently living in is $100,000, and they put a $5,000 deposit. Both mum and dad both had jobs, right? And they could easily make another $5,000, right? They put a $5,000 deposit in a house. Had they just invested it into like a great company within the S&P 500 or just the S&P 500, after 20 years, my dad would be on more than $1 million just from that initial $5,000 investment. When I showed that to my dad, I could see like it hurt him inside a little bit.
Oh, poor bugger.
Because he didn't know about it, and he doesn't have $1 million now. You know,
That's
so it's
painful.
like when you're acting out of scarcity, you tend to like not see the bigger picture of like how you can actually grow. So it just comes down to education, man.
Get those fear goggles on.
Yeah,
Right? They're just blinders, just
Literally,
looking in
yeah.
one direction.
Yeah.
Can't
But
see
I
the
can
opportunity.
understand, because you know, you come to a different country, you don't speak the language well, and all you want to do is just make a better life for your kids.
Mm.
And would you say in that example as well, like right now we're probably in like the best time to invest, because you got so many different platforms you can use. You got so much accessibility to everything. Back then, your dad would have had to call like a
Literally
financial advisor or broker or
there was
something.
there was internet,
Yeah.
but like how can you trust the source?
Yeah.
Back then, you know. So he would have had to read books.
Yeah.
On top of, you know, taking care of 3 kids, maintaining a household, and also going to work a night shift. So my dad's gone through a lot, man.
Calling up some random dude and them telling you exactly how good they are. Like,
Yeah.
yeah, all right, I'll invest with you. Fuck, that's terrifying.
So like I think we have to give like, I don't think there's stupid people out there. I think it's just uneducated people.
Oh, for sure.
Yeah, absolutely.
So we got to give them a little bit of slack. If they just educate themselves on this,
Yeah.
their whole life can change.
Well, we talk about how lucky we are to be born now and the age that we are, you know, with
Definitely.
the internet. Like, bro, we can tap ourselves on the back as much as we have now, but if we're born 50 years ago, the conversation is different. You know, we don't know.
If we were born in the 80s, I mean, okay, so let's say we were born in like when Warren Buffett was in his heyday.
Yeah.
We don't have the internet. How the fuck do we find out about Warren Buffett and invest in Warren Buffett? How do we even
Dude.
know Warren Buffett's the good shit?
Yeah. So tough.
We probably would have stuck at Nando's. Be like, Nando's is the best shit.
And then there's the thing as well. It's like, well, if someone's done it, it was possible back then. So it was like, it certainly wasn't impossible. It was just different and arguably harder than it is now to do that.
Yeah.
So,
and Warren Buffett, just to give context, Warren Buffett, he's a legendary investor who's outperformed the S&P 500 by, I think his returns were 20% over 50 years or something.
Yeah, something like that.
He's averaged 20% over 50 years. He's obviously a one of a kind, but someone who has influenced Warren Buffett's way of long-term holding, just long-term buy and hold strategy, which is Warren Buffett's strategy, was Philip Fisher. And he started his fund in like the 1930s of just buying long-term investments, assets, and just holding them for a long period of time. And he has a great quote on there, which is, don't buy the needle in the haystack. Don't try to find the needle in the haystack. Just buy the whole haystack.
Yeah.
And that's essentially what you're doing with the S&P 500. Don't try to like hand pick a stock, like a nickel mining company, whatever, because chances are you don't know much about it. Just buy the whole damn economy.
Yeah. And just as a reminder for the audience as well, like, you gotta remember, like, we didn't come up with any of this knowledge. We just found it through our system of finding A-class people.
yeah, absolutely.
You know? So all of this stuff literally comes from like typing on Google, who's the best investor of all time? Oh, Warren Buffett. He pops up. All right, read all the Warren Buffett books, watch everything about Warren Buffett on YouTube. And what does he say? Hey, if you're new with investing, start with the S&P 500. He's got literally a video that says, hey, if he dies with his wife, hey, put all of the money, you know, in the S&P 500. And then, like, it's really great. Like, you can type in, like, if you want to learn about bonds, Warren Buffett's thoughts on bonds, you know, Warren Buffett's thoughts on S&P 500, Warren Buffett's thoughts on this, you know, you can just keep on doing it and it's going to pop up with something.
Yeah.
So that's
the
how lucky
beauty
we
of the
are.
internet.
Yeah.
Yeah.
My dad comes from a similar time as your dad, obviously. And he said, this is like, I reckon this is the smartest thing he's ever said. When you're searching in on Google, just ask as dumb as a question as you possibly can, and it'll give you the answer.
Yeah.
So I was
So
like,
true,
type in all the words as possible.
Yeah.
I was like, he doesn't know how to use fucking Google. he come up with that shit. I'm like, all right, not bad, not bad.
I bet you he was great at using Ask Jeeves.
It's ridiculous. So I think, Dill, you were touching on previously, and this is something you told me, that most people can't outperform the S&P 500.
Yeah, so the mindset behind it is, hey, you're getting 10% with no effort. All you need to do is just sit on your hands and wait. Because people are running these great companies like Elon Musk, Jeff Bezos, and all of these guys. So what a lot of people do, they, you know, invest their money in some business that they've never worked in before, some franchisee. We had that story before during COVID, that poor family, you know, from Vietnam, they invested $400,000 into a franchise. And they lost it all, you know, because they didn't have that experience. Like, imagine that. You're putting your whole entire net worth in one thing, you know, in your business that you run, where with the S&P 500, you can put your money into 500 of the best companies ran by billionaires, the smartest people in the whole entire world.
Absolutely.
And not only that, you do no work. So our mindset's always, hey, if you can't beat 10% with no work, you may as well join.
Absolutely.
You know?
I've got a question for you boys, though.
Yeah.
Do you guys think that, you know, when people get educated on something as like a great investment vehicle like the S&P 500, where it's literally a set and forget, you literally just sit on your hands for the rest of the time. Do you think it's sitting on the hands which is the hardest part for people? They want to always be doing something with their hands to want to feel like they've earned it.
100%, man. I think we're taught literally from school. You know, everyone's heard we're taught to become employees. We're taught that our money is directly correlated with how much work we put in.
Yeah.
Yeah.
So if we're putting in 10 hours, we get paid for 10 hours. It's very, very simple. We can't, it's like we're taught for so long and it's ingrained in our brains, you know, and we cannot get rid of that part of our brain until it's just like one of those light bulb moments, where it was personally for me.
Yeah.
It was like, bing, you're telling me that I remember it. I was at Nando's and I was working my butt off, and my paycheck was absolutely nothing. You know, it was a decent amount, but for a young kid anyway. And then there's me looking at these lawyers and going, they must be working how many freaking hours to get rich as shit? Then looking at Jeff Bezos, like he's worth 160 mil a bill. How many freaking hours are you working? Like, you can't work more. Like, as in, there's not enough hours in the day for you to reach that amount of money.
Everyone has 178 hours in a week.
So
if we all have 178 hours in a week, how is Jeff Bezos worth 180 bill?
Yeah.
And a regular person isn't.
Yeah, it's simply not possible. So we need to just get rid of that mindset. I believe that our output is directly tied with our input is directly tied with our output.
So I've been having that conversation with my dad as well. It's I want to write a book one day about my dad, because like just the conversations I have with
Indian
my dad.
version of Rich Dad Poor Dad. Because poor dad, poor dad, rich son.
Because whenever I'm like explaining things to my dad, I can see the psychology of like the everyday person.
Yeah.
And it's so obvious. And I'm just like, yeah, okay. I'm learning way more teaching my dad, because he has an issue with just sitting on his hands. He wants to work. He's a working man.
Yeah.
I think that generation more than anyone as well.
Yeah.
Like kids these days, I think probably our generation is the last one who we definitely had internet when we were growing up, but it wasn't what it is now. So it was like everyone younger than us has grown up with internet all the time.
Yeah.
Anyone older than us grew up where labor was, the thing you get paid for the most.
Yeah.
Yeah.
So I think it is very difficult for, that generation to just kind of switch that off. Because one thing we know by mentoring and teaching people is it's easier to teach someone who's younger because they have less bad habits. So the older person is always harder because they've been, taught so many incorrect things for so long. So you have to essentially teach them first to scrap everything they know. And it's incredibly difficult to do as a person, because a lot of times that's what your identity is wrapped up in.
Yeah. The saying is, like, in terms of hard work, great judgment will beat hard work. So if you can make really great investment decisions, you outperform everybody.
Yeah.
So it's like everybody's like on this rat race, just running in a circle, working so hard, sweating. But if you can just find, the elevator to success through knowledge, it's just way easier.
Yeah. Why not take it?
Yeah. And everyone's just like, oh man, but life's so hard and all this stuff. I want to enjoy it now. Like, yeah, life's gonna be hard no matter what.
Yeah.
But if you just think, you can just grind a little bit for a few years, set yourself up, and then life actually becomes way easier, way quicker than you actually can imagine.
What's that great analogy that you were saying about, like, if you had two people digging for gold, and one person you give them you give them like a shovel, right? And then one person doesn't even think twice. He just starts digging.
Yeah.
And just keeps digging. The other person thinks a little bit and is like, how can I speed up this process?
So, and let's just put the context. So the guy that just starts digging, he's on steroids.
Yeah.
Right? He's on steroids.
He's jacked.
He's jacked.
Let's go.
The other one, he's a scrawny little fella.
Let's go, G.
That is a big distinction.
He's a little scrawny fella. So that's the thing. And this big buff dude's just like, man, I'm going to get that gold.
Let's go, Summer.
And then what does he do? What does the skinny
And then
fella
the
do?
scrawny guy thinks a little bit and...
Wait, let's recreate this. I'll be the scrawny guy. You can be the jack guy.
Sure, okay. So G, the scrawny
G.
guy.
Well played.
G
So
decides
you're
to...
You're digging, and then I go away. I read some books,
Read some
Oh,
books,
I know
yeah.
the name of the book.
What?
Skinny Indian, Buff Indian. A book about finance.
I had some Purple Cow market.
2 books to write.
I got 2 books, boys.
You're on fire, man.
Yeah, man. Thanks
Best
for the content, boys.
Anyway, so this analogy, right?
Yeah, so G goes back and reads a few books on how to dig and how to find metals in the ground, right? So he educates himself, comes back,
like 2 or 3 years later.
2 or 3 years later. Well, I'm just sweating. I'm shredded at this point. Right? I'm jacked, right?
Bro, you've been digging for 3 years.
I've been digging for 3 years, and then G comes back, gets a metal detector,
Yeah.
right? Finds the spot where it is. Then he goes back and then he he invests and buys a machine that digs.
Yeah.
I
then
come back
he's-
with the fuck off crane.
He comes back with a
This
fuck off
massive
crane.
fucking crane.
Yeah.
I'm just digging there, and I just look at this crane. I was like, fuck.
So he got a standard job, saved his money. In his spare time, he got educated,
Yeah,
combined those two things, and built and bought this big crane.
yeah.
This is big drill.
And Sameer beat him over the head with the shovel he was digging for 3 yeyears with.
Well, no, I'm stuck in the hole. I'm stuck in the hole that I dug.
G used the crane to fill the hole back in.
Yeah. This became very morbid.
And then
Yeah, my bad, boys.
G has that much money that he goes on Amazon and buys the book, The Dip by Seth Godin. And he just starts chucking it in the hole. He's like, mate, you got to read this book.
Throws a book of
Oh.
self-awareness in
Yeah,
there.
this will solve your problem, son.
So that analogy, I think, fits
Yeah.
quite well.
Yeah.
Yeah.
Just
Oh,
talking about
shit.
Seth Godin. You know what we were saying before about the education system. Seth Godin is a great author. He talks about this all the time. Like the book, The Dip, it's like only like a 2-hour read or something. It's a really, really
Yeah.
short book. And he's like, hey, at school, we've always been taught, oh, you have to fill 1,000 words on this essay. So remember when you're at school, you're like doubling up every word. you
And
know?
thusly,
Yeah. Just to hit that target.
yeah,
But he's like, that's not how real life works. You want to be more condensed so you save people time
Yeah.
and you add them value. Get to the point quicker.
Mm.
You don't need to add all these big ass words into it. So, like, that's another thing about, the education system, how it's failing us.
Something I'm learning at the moment. I wrote out this thing for an Instagram post. Sound like I'm trying to be William fucking Shakespeare. It's ridiculous, son. This is mad.
yeah.
Oh shit.
What's some of the other benefits of S&P? Oh, I think the other big point is it's 10% after tax. Because if you can find a great investment that you just hold forever, if you don't sell an investment, you actually never pay tax. And your goal as an investor is should always find a way to hold investments for more than a year, because with pretty much every country across the world, there's like a long-term capital gains tax and a short-term capital gains tax. So if it's short-term under 12 months, you pay more tax than if you sell after 12 months. And then if you hold forever, it's tax-free. It's tax-free. So yeah, you always want to find a way. Can you beat the S&P 500 with less work and after tax and get better results?
Mm.
It's very difficult to do.
Absolutely. I think one thing about investing in the S&P 500 really solves is how, like you were saying, how easy it is to do. Not only is it easy to set and forget, but like actually clicking the buttons is easy and starting it is easy. We live in good old Australia, and in Australia, essentially real estate is the name of the game here. And it takes, if you're kind of looking at real estate correctly, assuming that you are, and you're looking at 20% down and all those kinds of things, it's pretty expensive to get started.
The average house here is like $1 million now.
Yeah, it takes a lot of money.
Mm.
And with the S&P 500, it's not that way. It's a very low initial starting cost.
Yeah.
So to kind of get some skin in the game and to get started along your investing journey, it's much, much easier to begin.
Yeah. And if you love real estate, you can just use the S&P 500, invest like $100 a week or something, and that can get you to your down deposit quicker if that's your goal.
Yeah.
I think a harsh reality, especially in Australia, is unless we get some big bust and things just topple over, people are going to need to really multiply their money in ways like, with the S&P 500 or with an investment strategy, just to be able to, intelligently buy a house.
Yeah.
Mm.
Or even to even pay off a house.
Yeah.
The house prices are ridiculous. This is something that they were already ridiculous when we started Hardcore Headstart, and now they're even more crazy.
Yeah.
Yeah.
So it's making more and more sense every day to start investing in stock market, something that's liquid, easy to do, to end up purchasing a house for yourself.
Yeah.
Like what we talk about as well is like so many people, they say, hey, I made money from this investment. I made money from this house. Sameer's dad, a great example. He did make money, right? Obviously, because it's actually really easy to make money. Because, if you're just holding cash, that's the worst thing you can possibly do. But sadly, he couldn't outperform the S&P 500. It's not about just making money. It's about, are you actually outperforming it?
Some years he may have outperformed it, but if we're looking at like, you know, a 30-year window, there's no way he outperformed the S&P 500.
No. Oh,
You know?
absolutely not.
And whenever I'm doing like investing consultations and stuff, people ask me, can I lose all of my money if I invest in the S&P 500? The answer is yes, you can. There's a risk to everything. You can lose all your money. But if you do end up losing all your money in the S&P 500, what does that mean? That means every company, every massive company in the world doesn't exist anymore.
Have to be a
what the
nuclear
world
war.
looks like.
Literally. And then imagine companies like Amazon, Google just disappearing overnight, right? At that point, money would be the least of your concerns.
100%.
Like the world is in complete chaos at this point.
Yeah, it means every other investment is screwed as well.
Everything is screwed.
We're not using money to transfer any kind of value at all.
Yeah.
We're using our left toes at that point, for Christ's sake.
So I just like putting that into context of like in terms of risk with your investments, S&P is like one of the safest long-term investments that you can.
Short term though, it is quite volatile.
It is quite volatile. You know, short term, it is a stock market. Everything goes up and down short term. But if you look, you know, at like a 50-year window, 50 years is generally how long people work, right? If you look at a 50-year window, it has averaged 10%.
Yeah.
The other thing that we say to people is people tend to seem not to find their house as a risk because, you know, that it's a tangible thing. For example, my dad doesn't think a house is risky, right? But if my dad could see the daily fluctuations of the house price, it would drive him insane.
He would have had a heart attack.
He would have had a heart attack.
Especially with 5 times leverage.
Yeah.
You're only putting 20% down.
Yeah.
Big swings on your capital.
Absolutely.
Yeah.
Real big
I think
swings.
the difference is you're just seeing like the price fluctuations of a business, which is the S&P 500, but with a house, you're not.
Yeah.
So that's why you can sleep well at night when you have a house compared to
So yeah,
stocks.
just recently during COVID, I think the correction was 35% or something in 4 weeks. It's very fast on the way down. During 2008 financial crisis, it went down not as fast, but it went down longer over like a 1 year period. It went down like 55%. But the way you can like get around that is through this thing called dollar cost averaging, where you just average into the market slowly. So yeah, market's going in a zigzag, but you just average in nice and steadily, put money in every month or so. You're averaging in, and then you get that 10% over the long term. But anything that's a potential downside, like that volatility, it's not actually, you know, volatility doesn't actually equal risk. So if you just sit on your hands and hold through it, you know, you'll walk away with a win, because at the end of the day, they're actual real companies making real money, backed by the richest people in the whole world. They got so much skin in the game. And maybe one other point just quickly is when the market dips, what is that? We talk about it all the time. You got to buy the dip because it's a massive opportunity. Because when you're buying at a cheaper price, those buys down at the lower price, you know, everybody was saying, oh, I wish I bought during COVID.
Yeah.
Oh, I wish I bought during the 2008 financial crisis. You know, you could. There's always going to be another thing. And those buys at those lows will outperform 10%.
Absolutely.
Because they got such a cheap price.
Same people who said they wish they bought during COVID, the same people that were saying, I wish I bought during the 2008, unfortunately.
Oh, yeah. I know.
Guaranteed. People always stay out the market.
Yes. Another way of looking at it is like if your house is a stock, or if houses are stocks, if you buy one house, you're buying one stock, right? You've literally got all your money in one stock.
Oh, yeah.
Yeah,
And one rule of investing is diversify your portfolio to avoid risk. So if you've got all your money in one stock, and it's fluctuating like crazy,
It's risky as hell.
it's very risky.
That's an interesting, like, kind of little thought there. Like, look at your real estate, look at a home like a company. Like, and this is definitely going to be a bull case for stocks. But think about a company. What does a company do? A company, I mean, like a company like Amazon. How much profit do they actually kind of make? How productive are they on a hourly, daily, weekly, monthly, yearly basis? It's ridiculous. They grow by 30% a year. I think it's like still where it's at now is like 31% a year. All right. that makes sense why it appreciates 31% a year. And why it grows by 31% a year, because of how much value it outputs. Does a home really do that?
Yeah. It just stays the same.
It literally doesn't change.
Yeah.
If you were to make a balance sheet of your home, like put assets, put like income and expenses, the expenses column will be crazy.
Mm.
And then if it's like a home that you're living in, you're not making any income from it. You're spending it all on expenses.
Yeah.
I think that's a good point. Like the house that you're living in as well. Like that's exactly what we're talking about today.
Yeah.
We're talking about the house that you are living in. We're not talking about the investment properties and all the different schemes of that, because it's a whole different conversation, and we'll touch on it one day.
Yeah.
Yeah.
Yeah. But this is good, because like now when someone's like, all right, I made money from my house, now you can start to think, well, what percentage did you make? What's your 5-year track record? Have you been compounding in a rate of 10%?
Mm-hmm.
You know, what's your actual results? Have you beat the gold standard?
Mm-hmm.
You know, if not, you might not be, you might be getting opportunity costed a little bit.
Yeah.
I think a great way to see the S&P 500 is very little work, set and forget. It's kind of like you got a cash machine there. You know,
Dude, he wants
cash
the
machine.
you got a cash machine there.
Cash
boys.
machine. He wants the screaming cash machine. You know, I got a little thing to share with you. I'm sure we can play the audio over here if we want. But I heard the other day a cash machine, and I bought one on eBay, and I got it sent through to us, and I thought, fuck, this would be a good time to share.
Wait 1 second. So it's like an inside joke. We put noises depending on like how good your return on investment is. So if you got 1% in the bank, like it's not really a good cash machine.
Yeah.
If you get 10%, she's a little bit she's got a good motor to her.
Yeah.
If you can beat 10%, mate, she's phenomenal.
So up until this point, we've been talking very nice and soft
Yeah.
for a reason.
Yeah.
We're about to take it to the next level.
How do we actually explain this joke so people understand?
We don't. We just don't.
I guess it kind of relates
That's
to...
if you're making more than 10%.
No. So the way
none.
we explain this inside joke of a cash machine, right now, if you're not investing in the S&P 500, you essentially don't have a cash machine. So you can think of it as like it's there, but like it's not switched on,
Yeah.
right? So once you start dollar costing into the S&P 500, you're just, think of it like a lawnmower. You just, you're putting the oil in it, you're pressing the button on the side. And then once you start making profit, if you give it a little
rip.
oh, mate. Oh, mate.
But yeah, like the smarter you get, it's like you're adding parts to it. You're getting a V8 engine on this thing. She's going hard. She's like a motorbike.
She's like a Harley, son. Go on, mate.
All right. No, so let's talk about this. So it relates back to the podcast we were talking about doing the detail cleaning, and we have this crazy industrial vacuum cleaner.
Oh yeah.
Right? That she's so powerful. And what does she do, G?
Oh my, you switch her on, and then she goes, "That's the good shit."
That's good shit.
All you have to do now is the same thing with your finances. You just have to
Yeah.
switch it on, and you go, "That's the good shit."
I feel like she makes a little bit of a different noise. Give us a different noise.
Go on.
If you get real smart and you can really upgrade the thing to the next level, she starts off going. That's the good shit. That's the good shit. This has to be the only podcast in the world. We're helping people with their
I just
finances.
told you what inflation was, and this motherfucker went, I can't even do it.
Oh, man, that's the gold standard, boys.
That's the gold
Oh, that's the best
That's the
shit,
gold
man.
standard.
So, yeah,
How
next
do we
time-
segue?
I don't know, maybe like next time, so you hear your boy talking about your friend, I made this much money from this investment, then just put a noise to it.
Yeah.
Just like,
Don't say words, just put a noise to it.
They're just like, "Oh, mate, I'm making 3% return per year, putting my money in this bank." She's not even starting, boys.
There's no petrol. You need the petrol.
Got to give it a little tap on the side. Put the oil in there. She just starts stalling, boys.
But yeah, this also relates to people always said like, "Hey, son."
How are you relating this?
Every time he's saying this relates, I'm like, how the fuck's the segue in this shit, bro?
So people are like, but money doesn't grow on trees, Dylan. You know, but if you got a cash machine, she kind of just prints herself. You know, so wealthy people, like, what are you talking about?
The government has a cash machine printing dollars. You need a cash machine making you money.
Yeah. Investments, man. Investments.
That's where the S&P 500 comes in.
Yo,
Yeah.
if people are not pissing themselves right now. Yeah, on Dad's if you're not laughing your head off, stop watching, man. Like, this is the funniest financial podcast you've ever seen in your life.
But talking about robots and machines, right? So thinking like you got a house. A house is just a house. It's bricks, it's mortar, it's materials.
Right.
She doesn't change.
Right.
You come back in 100 years' time, she's probably degraded, you know? Unless she's built real good like the pyramids, she's probably gone. You're going to have to invest money to maintain the thing. Whereas think about a robot or a machine. Just like we posted on TikTok. Elon Musk, they're talking about how do you make a robot that costs $30,000 that can replace a human forever. So if you're paying a human $30,000 every single year, you can get a robot, replace it, plug her in, recharge her.
Pay like $25K one time.
One time,
For it,
a once-off payment.
Yeah.
Maybe a little bit of maintenance here and there, and then it works 24/7, never complains. And then the next thing is like, all right, now how do I find a way to make this robot more productive? Upgrade the robot, you know, make version 2, and it gets twice the speed. Then how do you make that robot even better? You always find a way, like, you know, through like Moore's law, like how technology progresses over time. Like with Moore's law, we're seeing our computer chips over time, they've been doubling in power, like what is it, every 18 months or something like that. And they've been halving in size. Like this is going to happen with robots. And then soon the next level is like artificial intelligence, where the artificial intelligence can get so smart that it can code the robots, or it can figure out ideas how to make the robots
Have
better.
you guys heard about Elon Musk's machine that makes machines?
Oh, yeah.
He calls it the Optimus. So in his Tesla factory, people aren't putting the cars together. It's a machine that's putting everything together. So it's a machine making a machine. So that's just what we have now. So you can imagine like a future,
Oh, yeah.
how
Next
crazy it will
level.
be.
Absolutely.
And even like talking about the self-driving, people don't understand how it works. Like self-driving has like an algorithm or an artificial intelligence that learns based on its experience, right? And then whatever happens to it, then you can code a little bit, make alterations. But the thing is, it's actually learning. Now, over time, we have to compare that to a human being, right? A human being, it takes like X amount of hours. What is it to get your P's these days?
220.
220.
120.
Yeah.
120
Is it
hours.
120?
120, yeah, to get your P's, yeah.
Yeah, let's say it. So
Yeah.
between 100 and 200 hours, whatever, to become a decent driver. That's how fast a human can learn. That's pretty damn quick. Whereas a car or an artificial intelligence takes way more hours than that currently. But the thing is, one car is out there just constantly acquiring data and acquiring data. Now that car is sending data back to one supercomputer brain, you know, like at the headquarters of Tesla. And then each of these cars that are going out on the road, it's like those are then getting, you know, imagine there's 2 cars. That means twice the amount of data, twice the amount of experience is coming in, going back to the one supercomputer.
Yeah.
So it's like an octopus. And eventually there's an inflection point where it just gets so smart that it's way better than human, and he just won't make any mistakes.
I think Elon Musk, he's the master of predictors, good and bad. Sometimes he misses. But he said that full self-driving will be better than human being in regards to like crashes and risks and all that kind of stuff within like a couple of years.
It's already like that now.
Yeah, like he said, fully like 100%.
Yeah.
Just let it run and play. Like you see these little things now and then that are questionable. He goes, they won't exist in a couple of years.
Yeah.
And people believe like that all of those things in the world, robots, everything that is happening is better for the quality of our life. It creates more abundance for us. It creates better goods and services. Everything's done to a higher quality. You don't have to worry about human error. Computers are fundamentally perfect.
Yeah.
They create everything better than we can do it. People need to, I believe, realize that's A, going to happen, and B, don't be upset about it. Upskill yourself in a way that you can learn somewhere else and let yourself enjoy the abundance.
And one way to enjoy the abundance is just owning a piece of it
Absolutely.
in the S&P 500.
Damn right.
You know, if you can't make your own electric vehicle that's on the scale of Tesla, just don't fight it. Buy it.
Absolutely. 100%.
And I was thinking as well, even though we were joking about the cash machine, there is like this truth to it that you're doing the same amount of work, like saving your money and investing into the S&P 500. You're doing the same amount of work, but the S&P 500 is making you 10% more each year on average.
Yeah.
From doing the same amount of work, you're making 10% more on your money each year.
Why not do it the smart way?
Yeah.
She just makes sense. And like that's the 10% is like, as we started to put, that's the golden standard.
Yeah.
Right. That's that's the average. You know, so 10 times your money is the average. That's how far you got to realize how far away you are. That's the average. There's people in the world like the Warren Buffetts and many more people who are getting better than they're the average. Way better than the average.
Yeah, you can smash it.
And I remember first starting this, like, and maybe you can explain it, maybe the way you explained it to me in the beginning was like, it's possible to beat it if you want to. If you want to actually try and beat that 10%, you have to put the work in, you have to get a shitload of knowledge, and you have to look at the world a certain way, understand a certain amount of foundations, and you can beat that 10%.
Yeah. You just need that self-awareness. Do you actually want to do it? If you're inspired and you're like a builder, you're a doer, and you want to, figure this stuff out, go for it. But just have the self-awareness and understand when you 100% know you can outperform it. Because we've seen people as well, they read books for 1 or 2 years, they reckon they're a genius all of a sudden. And then sadly, we see them lose all their money. So, you just got to be careful with this stuff. But it is possible. And, just think about like anyone that's ever, like, that's becoming super successful, and especially like quickly, they have to have beat the S&P 500. So, Bezos, Elon Musk, these guys, they're smashing it. Think about guys like Logan Paul even. Yeah. How can you become a multi-millionaire in your early 20s? You have to be getting way more, from all your business endeavors and all of your investing, way more than 10%.
He made his first $1 million after tax liquid in the bank just after the age of 21. You don't do that by saving money.
Yeah.
Or even getting the 10%.
Yeah.
That's like almost someone's lifetime earnings.
Yeah. Absolutely. No,
That's it.
Ridiculous.
You guys want to quickly talk about Peter Thiel?
Yeah, like there's a famous story of Peter Thiel, who he's a billionaire right now. He's a real famous technology investor. He wrote the book here, 0 to 1, which we highly, highly recommend. I feel like it's a must read if you really want to understand the importance of technology investments. It's an all-time classic. So we always talk about Rich Dad, Poor Dad, give you the foundation, understand technology investments, why they're so important, 0 to 1. If you're young as well, you probably already know, like, this technology stuff, it's not going away. It's changing the way, we live. It's changed everything, really.
100%.
But yeah, Peter Thiel, in his, like, it's a thing called a Roth IRA, which is like a tax-free vehicle where you can invest some money there for your retirement.
It's the American version of our Australian super.
Yeah. It's like a self-managed super. I think the rules are your max you can put in is like $6,000 a year or something into this thing.
Yep.
He just put in like $2,000 to start, and if you can only put in $6,000 a year, somehow he found a way to grow this thing through knowledge and all of that to $5 billion. It's the biggest tax-free Roth IRA in the whole entire world. And this guy's probably like 50s. He's not that old.
He's chilling.
Yeah. $2,000, $6,000 investment a year max.
Yeah.
$5 billion.
$5 billion.
Professor Peter Thiel, he was the first VC investor at Facebook.
Yeah, first.
He was involved in the building of PayPal.
Yeah, with Elon Tusk.
Elon
Elon
Tuskin. I mean, what else? Anyone else got all the list of things
He's
he's done?
current CEO of Palantir.
There you go.
just Google search some of this stuff, man. Watch it on YouTube, like what Palantir can do and all of this.
He's next level.
He's on the cutting edge of technology, so he knows.
Dude, I'm gonna be honest. I don't know anyone in the 50s with even close to like $1 million in their super.
No, yeah.
Yeah. Oh, it's very, very rare, I reckon.
I'm sure there's people with $1 million, but fuck,
Yeah.
When we grew up,
5 billion. Like what? How do you do that?
I think,
Weston.
less than 20 years, by the way.
that's-
20 years. So from 1999 to 2019, which is when we found that 5 billion stat from, he turned it from 2K to 6 bill, only adding 6K every week. So his multipliers,
every
what he was
year.
investing was in every year. Thank you, G.
Yeah.
Every year was ridiculous.
Yeah. And this guy worked extremely hard. So this is what you got to really understand is when we're saying, great judgment beats hard work. When these guys work really hard, it's not like they continue to work really hard at their job. It's to acquire knowledge, because that allows them to increase their returns. So like you might only be able to get the S&P 500 10%. Then through your own investing, you might lose money to begin. Most people actually, if they started investing by themselves, if you told them you're not allowed to buy an index fund, they will lose money. Most people. Give them a couple of years to upgrade their knowledge, they might start going flat. They can't beat cash yet. Maybe slightly under cash. Give them a couple more years, then you can get close to the S&P. Give them a few more years, you can get above. So that's what the smartest people in the world they do. Like look on Elon Musk. You just type in his name. Like what does Elon Musk advise to a young person? It pops up. Read a shitload of books. Elon Musk's thoughts on university degree. And it's there. All this stuff. It's all online for us. That's the beauty of it. So
we actually have a TikTok on Elon Musk advice to young people. I think we can put that in the show notes.
Yeah,
Absolutely. Yeah, for sure. That's the thing. Like young people, or just really everyone, every time they say, I'm so bored at the moment. Bored. Have you heard of fucking Google? Bored. There's more shit than ever to fucking learn. How can you be bored? It's mad. I don't know. It just gets me every time.
I think the problem now is like young people are more distracted than anything.
Yeah, it is.
Yeah.
That's a problem.
yeah, just type in Amazon robots on YouTube.
Go down a rabbit hole.
Type in the NVIDIA
Oh yeah,
AI. Or just NVIDIA, like with the serving machine.
Oh yeah.
Now you go to Macca's, you do a self-serving. Type in that from NVIDIA. Just go have a look what the internet's or what the world is possible. Building. You know what I mean? Fuck it.
Yeah. And then just get really familiar with like compound investing. Like go on compound interest calculator. Just mess around with the numbers.
Yeah.
Remember that 20%. If you can get 20%, if you can figure out a way to do that, identify if that's you want to beat the S&P 500. If you can, 20%, a $10,000 investment once off in 50 years be worth $91 million. 91 milli.
Absolutely.
Big numbers, man.
Should we do a little summary?
Yeah, go
Okay.
for it, man. Go for it.
Okay. So I think G touched on it at the start. One of the most important thing is to kind of how to picture the story of what we're telling today is the different levels of kind of return you can get. And that's, you first start off from the previous podcast of budgeting, how to save money. Where do you save that money? Save that money in the bank, right? That's level 1 right here. Level 2 is the golden standard. That's, investing in the S&P 500, which on average returns 10% every year. And that's, and level 3 is that it is possible to beat that 10%. There's many people in the world that do. We aim for 30%. We've been getting above 20% consistently, and there's people, Warren Buffett, he's compounded 20% for 50 years. Peter Thiel's got $5 billion in his Roth IRA.
Yeah.
People like this. So I think that's kind of a summary of the story we were telling today. And we spoke about an exercise. Please go Google the S&P 500 holdings. That's the 10%. That's the golden standard. That's the average level 2. So go check that out. Make sure you understand, you're familiar with that. Dylan just spoke about being familiar with compound. Be familiar with how all that works.
Yeah. I think as well, that's a good summary.
Yeah.
And one other thing is like, if you see people complaining about like big companies and stuff like that, like, oh, they hate Apple, or they hate Google, they hate all of this stuff, or I hate Louis Vuitton. Like, look and research them. Like, why are they so profitable? How much, did they compound at? And it blows 10%. Study the best.
Yeah. Counterpoint is how much good they've done in the world all the time.
Yeah.
So,
and that's our goal. Our goal is to help everybody around us, help ourselves first financially, spread the message now, like what we're doing with the podcast. Then that gives us all time back, build this massive community. And if we can all work together, not only we help each other, but we can help the rest of the world. And that's what it's about.
absolutely.
We have that collective goal of donating $1 billion in our lifetimes. So
Absolutely.
to do that, we can't just save our money.
That's it.
Yeah. And reach out to us, ask us questions. I noticed a lot of people on TikTok comments would just jump to conclusions. But the important thing is, like, if we know something, ask us. How do we know it?
Yeah.
Absolutely. On that note, thank you very much for listening. I think it's been an absolute banger of an episode again.
Yeah.
Please like, comment. As G said, DM us all if you need something. Click that subscribe button. Make sure your notification bell is on so that you know when we upload, because we are back to weekly uploads. And we will see you in the next one. Back her up.
Pack her up.
Pack her up.
Hi, boss.
Thank you for listening.
Boy, someone do thank you for listening. What the fuck?
Do it properly.
Thank you for listening.